Greetings to all. Here we are going to discuss about the topic venture capital. So venture capital, it is a form of financing that provides funds to early stage or the emerging companies which has a good growth potential. So here they encourage the risky projects, that is the projects which are highly risky in nature. So their main objective here is to earn a high rate of return. So the venture capitalist, they take the risk of investing in startup companies with the hope that they get a good returns in the future and they can be successful. So next one is the features of venture capital. So first is high degree of risk. So the venture capital represents the financial instruments which are very risky. So their main objective is to earn a high rate of return. So not all the capitalists will experience high risk, but the venture capital financing usually it contains risk, but the risk is compensated here with a higher return. Next, financing new ventures. So the venture capital, it is a convenient source of raising finance for the startup or early stage business. So the new ventures, they face difficulty in raising the capital from the capital market in their early stages of operation. So the firms with a high innovative project and a higher growth potential are easily able to attract the investors who are willing to do the investments for the sake of earning a higher return. So third one is equity participation. So the venture capital financing is invariably, it is an actual or potential equity participation wherein the objective of venture capitalist is to make capital gain by selling the shares once the firm becomes profitable. Next, long-term investment or horizon. So this type of financing, it is a long-term investment. It generally takes a long period to encash the investment in securities which is made by the venture capitalist. Participation in management. So in addition to providing the capital, the venture capital provider will also take part in the business of borrowing concern and also takes an active interest in the management of the assisted firms. Lack of liquidity. So the venture capital investment, they lack in the liquidity in nature. That is, these investments cannot be encashed by the investors in the short term. So the venture capital investment or long-term investment, which can be either in the form of the loan or it can be in a form of the convertible securities. Next, aiming capital gain. So here those who provide the venture capital, they aim the capital gain. So they want the success to be achieved here by earning a higher rate of return. Next is the stages of venture capital. This venture capital has 5 common stages in financing the venture capital. So first one is the seed stage. So at this seed stage, the company is only an idea for a product or service. So the entrepreneur, he has to convince the venture capitalist that the idea is a viable investment opportunity. So in this stage, the entrepreneur must convince the investor so how ultimate the product or services and how it will be successful in the market. So here in the seed stage, venture capitalists participate in other investment rounds alongside with the investors. So second stage is the startup stage. So here in this startup stage, it requires the significant cash infusion to help the advertising and marketing of the new product or services to the new consumers. So here at this stage, the company has completed its market research and has a business plan, and they also have a prototype of its products to show it to the investors. So the company brings other investors at this stage to provide the additional financing. So next, third stage is yearly stage. So this stage is also called as the first stage or second stage capital. So it usually comes after the seed and startup stages. So at this stage, the product or services has been developed and being sold in the market. So this is the first opportunity the investor have to see how the product fares with the competitors in the market. So funding received at this stage will often go towards manufacturing, sales and additional marketing. So at this stage, the company could also be moving towards the profitability depending upon its share and marketplace. So next is expansion stage, which is also called as second stage or third stage capital. So here the business has already started selling its product or services and needs additional capital to support the demand. So it requires this funding to support market expansion or start another line of business. So here the funding is done for the improvement or for the expansion of their business. So the final stage is called as the bridge stage, or it is also called as pre-IPO stage. So the bridge stage represents the transition to a public company. So this is commonly the last stage of the venture capital financing process, and here the primary goal of this stage is for the startup to go public so that the investors can exit the venture and make profit. So the business here has reached the maturity and it requires financing to support acquisition, mergers and IPOs. So at this stage, the venture capitalists, they exit the company and they sell off the shares and they earn a huge return of the investments. So the exit of the venture capital allow the investors to come in hoping to gain from the initial public offering. That is, we call it as an IPO. Thank you.